Hey everybody, it's Shannon from alphatrends.net. Today's Friday, the 26th of February, 2016, and we had a nice continuation higher this week for equities. Only the biotechs lost ground on the week, and very slightly here. They did outperform a little bit today and try to go positive for the week, but obviously that didn't happen, and it's still the worst group year to date. The S&P 500, Russell 2000, biotechs, and Dow are all now positive on the month, but still obviously lower for the year. So let's take a look at the charts and see if we can make some sense of this. Let's take a look at oil first, since I had it right here. Oil, let's take a look at those numbers again for oil. Oil was up 2.7% this week, but still, when you look at it, it's still in a downtrend. Breaking a trend line doesn't mean that the market has reversed. It means that the rate of descent has slowed. Now, it's possible that you could just say that we're trying to stabilize in here. That's certainly a valid point. And maybe it comes down and creates a right shoulder if it's to pull back down towards 30, 29, 30, and then it could create a right shoulder. But the thing is, all these prior levels of support have the potential to act as resistance, and I don't think it's going to be a easy turn for oil to go back higher once again. So I really don't see any reason why people would want to be long it unless they are short-term traders. For the S&P 500, we still have a declining 50-day moving average. Now, this is where sometimes people get confused, and in their confusion, they lash out at me and say, what are you trying to say here? And the point is that we have a declining 50-day moving average. When we have a 50-day moving average which is declining, we tend not to trust the rallies. It doesn't mean you just sell short blindly. It means that these rallies have a higher rate of failure, in particular when we have the market below a declining 100, 150, and 200-day moving average. So the odds favor, but that doesn't assure that this rally will fizzle out. So what we have to look at is take it, little pieces at a time. And we have to recognize that we're still in a period where we have trend confusion, whereas, we're still below a declining 200-day or 40-week moving average. Any institutional trader will tell you, institutional investor, bulls live above the 200-day moving average, bears live below it, and it's bearish when we're below a declining 200-day moving average. So we have an overall bearish macro environment. Intermediate term, looking at a 120-minute chart here, we got back above the year-to-date volume-weighted average price this week. That was a positive. And what I had mentioned, or I believe it was Wednesday morning before the open, that we were getting into this band of prior resistance and it was gapping lower, and the key level to watch as it gapped lower was right down here because it was the volume weighted average price year to date. It was also, as we had noted, the 38.2% retracement of what had been the range for the month of February. So from this high and this low, 38.2% retracement brought you right down to that level. And further, it was also the location of where we had this blue is the 10-day and green is the 20-day moving average. So when we look at a daily chart, maybe that makes it a little bit more clear that we see the 10 and 20-day moving average right in there. So the market rallied up that day. It recovered very nicely from there. As I had mentioned, I thought it was prudent to sell some right up here at that 5-day moving average if you had gotten long down in there. And the market came up to this what's been a band of resistance, and it went right through it. Today we pulled back, and so far we're holding above that level right now. So when we look at it, for the week, the buyers were in control. Here's our 5-day volume weighted average price. Let me just draw that on here. Our 5-day volume weighted average price comes together right along with that 5-day moving average. So early next week, the key levels for us to hold will actually be, I think, 192.5 to 193. If it drips a little bit down below that, I don't view that as a huge negative, but we also have to be aware, again, the declining 50-day moving average rallies are considered higher likelihood of failure, and especially when we have a declining 200-day moving average. So we have, on a bearish scenario, we have the potential that this breakout attempt beyond this resistance will fail, and from failed breakouts often come fast fast or vast moves in the opposite direction. Now, we've built in some nice support down lower, in particular down near that 190 level. I think that's going to be a very important level going forward here for the next several weeks, that if we hold above that, then this market, doesn't really favor aggressive short sales. And, the important thing here as well is, a lot of stocks that I saw a lot of people looking to get short some of these stocks that had bounced, but, they continue to bounce, such as Akamai. Akamai, big bounce in this downtrend, and maybe it's reversing, but the fact is, with a rising 5-day moving average, you simply don't want to bet against the momentum until it flattens out and turns lower. Same is true for shares of Adobe. Adobe rallied way up to its declining 50-day moving average, but it's not ready for a short yet, not with a rising 50-day moving average. So know your time frame, know what makes most sense to you, and if you're uncertain, such as saying, well, I'm going to, some people will make the mistake of saying, I'm going to short Adobe at a 50% retracement, and they'll short it right there and then not have a stop. If you're going to do that, know your stop, know the key potential battle levels. A 50-day moving average is a key potential battle level. The 61.8% retracement looked like a key potential battle level, as that was also the year-to-date volume weighted average price, but it obviously continued to rally up through there. We use technical analysis as a guide, not as a one and all thing. We have to sell short at a certain level. We want to look at it and say, where do the odds favor us to get involved or to stand on the sidelines? The NASDAQ has rallied up to its declining 50-day moving average, and this is, this right here is a potential band of resistance right here, and then up to the next level. Now, I would think that it's likely that this rally will fail, but it's not to be a short until it gets below a 5-day moving average, and then it makes a pattern of lower highs and lower lows below that 5-day moving average. So, for instance, if we had rallied up to the 5-day moving average, backed off there, and then started to head back down, that would have been the place to sell short. We don't sell short on a big gap, because where would our stop go? If you did, your stop would go here, but the risk reward is not good. So you stand on the sidelines waiting until something matches what you're looking for in your time frame in the market. I'm not here to tell anyone what to do, but I do know that as a good guideline, you don't want to be short with a rising 5-day moving average. And as a good guideline, you don't want to trust that this is the turnaround in the NASDAQ, not with a declining 50-day moving average. So you've got to figure out whether you want to sit on the sidelines or if you want to play the shorter term time frames in between these important battle zones. The Russell 2000 has come up close to its declining 50-day moving average as well. This prior support has been resistance in this little area, so that adds credence to the likelihood that the Russell 2000 will find resistance near that declining 50-day moving average, but that it's only likely to. It doesn't mean it will. Again, what is the direction of the 5-day moving average? It's higher. We're seeing higher highs and higher lows. We're seeing a rising 5-day moving average. It does not make sense to sell short on strength. We want to wait until it turns lower. And this is the analysis that, similar to this video, every single day of the week I do this. So if you're just looking in once a week on Fridays, sometimes I hear people say, "Oh, Brian, last Friday you said it was bearish, and now this Friday you're saying it's bullish." Well, I change my mind during the week as price action dictates, and you can get this analysis for just $249 a year for the bronze level, which includes all these ETFs every single day. The semiconductors rallied past this prior band of resistance in here, and now the best potential for bullish would be that these markets come down and find some support in these areas, and over the next week or two, maybe that 50-day moving average can start to flatten out a little bit, and we can build a better base to launch higher, perhaps up towards this level. Now, I think that's the less likely scenario though, but you have to make considerations for what could potentially happen. Could we potentially rally up to the declining 200-day moving average? Absolutely. And that's why we didn't stay bearish last year when the market started rallying once again. We turned to bullish. Over here, absolutely. I'm bearish when they're going down, and when we have evidence that they're starting to turn higher, I am going to turn bullish in the intermediate term. And as prices adjust and tell me otherwise, then I will maintain that outlook. So for now, the semiconductors, cautiously optimistic. I'm optimistic because we're above a rising 5-day moving average. I'm very cautious because we have a declining 50-day moving average. I'm not here to play guessing games. I'm here to look at the market and look at it with a disciplined plan, and it's based on market structure and the way that money flows in a cyclical rhythm through the markets. So semiconductors, I think for next week, what we'd really like to see would obviously be for this level to hold. The year-to-date volume-weighted average price levels were tested this week, and we were told they were important because buyers stepped up in there. Now those are going to likely to be the higher lows that have significance moving forward. The biotechs continue to underperform, as you can see here. It's year-to-date volume-weighted average price, and this market group is significantly still below that level, about 15 points below it. So it would make for a nice rally up towards that level, but let's take a look at the intraday action. Here we can see on a 120-minute chart, there's the year-to-date volume-weighted average price. We are trying to find support at this rising 5-day moving average, so that's good on an intermediate term that it's trying to find support there. We also held above the week-to-date volume-weighted average price. So these are little clues that maybe the buyers are going to start to catch up a little bit in the biotechs. But you look at this chart, it's still really a mess. So when we look at, for instance, we can draw a trend line across here, and this has been the essence of trend. This has been the band of resistance that's held the biotechs back so far this year. Now, we have this could be a shoulder, a double-headed head, and this being a right shoulder. So for next week, it's certainly a possibility that we could maybe run up towards this level here. And I would actually prefer to see something like this happen, and then we get a push higher. So after a couple days, the risk, of course, is that if we break back down below probably 257, that we're going to go back and test this low, and the longer-term trend is still absolutely bearish here with a declining 10, 20, 30, 40-week moving average. Apple made a little bit of ground this week. If you look at the week-to-date volume-weighted average price, that's for the last 5 days. We did close above that, and we closed above the 5-day moving average. But when we look at it, was it really tradable? For it really to this is where it made a higher high, and then it was all on a gap. So if you chased it, by the end of the day today, you were losing money. Now, if this holds the support, maybe it can start to look a little bit better. But when we back it up to longer-term time frames, you can see that Apple is still drastically underperforming the rest of the market, and it is stuck in this range here that has been plaguing it for the all month, and it just does not look like a compelling purchase right now. Hope everybody had a good week. I will talk to you again next week, and enjoy your weekend. Thanks.